silver moved down sharply. In New York, silver dropped from $76 to $72. In Shanghai, silver pulled back to 78.15 per ounce. In China's domestic market, silver fell to 17,065 yen 1 per kilo after recently trading above 20,000 yen. At first glance, this looks like a breakdown. But here's the critical detail most people miss. China is still paying a $5 per ounce premium over Globex futures prices. In this video, I'm going to explain exactly what that means. We will see why this move fits only one scenario and how paper and physical markets behave differently during moments like this. This is not speculation. This is not hype. Only reality, explained clearly so you understand the silver market game. Let's restate the facts clearly. Silver in New York moved from $76 down to $72, while Shanghai moved down but is still at $78.15 per ounce. China's domestic price pulled back to 17,651 yen per kilo, from a record above 20,000 yen. China's physical silver premium remains around $5 per ounce over Globex futures. All of these facts are true at the same time. Only one scenario explains everything together. The correct case is scenario 3. A paper-driven downtrend. A controlled reset. This means the price decline is coming from futures markets, leverage reduction, and technical pressure. It is not coming from falling physical demand, excess supply, or a breakdown in real-world silver usage. That distinction is everything. Silver trades in two linked but separate systems. The first is the paper market, where futures contracts are traded, and the second is the physical market, where real metal is bought, sold, and delivered. When price drops rapidly from $76 to $72, that move is happening primarily in the paper market. Paper markets respond instantly to margin changes, volatility controls, position limits, and risk management rules. Physical markets do not move that way. This is why we must check whether the physical market confirms the move. After silver reached very high levels, futures positioning became crowded. When that happens, leverage builds and volatility increases. Risk managers step in. At that point, price no longer reflects long-term fundamentals, but reflects forced adjustment. Traders reduce positions not because they change their view, but because they must reduce exposure. That selling pressure shows up immediately on futures prices. This is exactly how silver moved from $76 to $72. Now look at Shanghai. Even after pulling back, silver is still trading at $78.15 per ounce. That is significantly higher than New York. If silver demand had collapsed globally, prices would converge lower everywhere. They did not. This price gap tells us something important. Regional demand remains strong, physical availability is still constrained, and the paper move is not being confirmed by physical flow. This is a classic sign of a paper-driven reset. The most important data point is, China is still paying a $5 per ounce premium over Globex futures prices. Premiums exist only when physical silver is tight. If silver were abundant, premiums would disappear, physical would trade at parity or discount, and import demand would slow. That is not happening. The premium tells us physical buyers are still competing for metal, local supply is not overwhelming demand, and the physical market is resisting the paper decline. China's domestic silver price fell to 17,651 yen per kilo after trading above 20,000 yen. That move looks dramatic, but context matters. Prices had risen extremely fast. Pullbacks after record highs are normal. What matters is whether physical demand vanished, premiums collapsed, or supply overwhelmed buyers. None of that occurred. Physical oversupply has clear signs. You would see large volumes being dumped, discounts to global benchmarks, weak regional pricing, and buyers stepping away. Instead, we see Shanghai still elevated, China still paying premiums, and physical metal not flooding global markets. That means supply has not overwhelmed demand. Major market cycles do not end with strong physical premiums, regional price gaps, and ongoing industrial demand. They end when physical buyers disappear, supply becomes plentiful, and premiums collapse. None of those conditions are present. This move is a reset, not a reversal. Let's say this plainly. Silver did not fail, silver did not break, silver did not lose relevance. What happened was a controlled paper reset after an aggressive rally. The futures market adjusted, and the physical market held firm underneath. At this exact moment, New York shows weakness because futures reset. Shanghai remains higher because physical demand persists. China's premium confirms tight physical conditions. The pullback reflects risk management, not collapse. Final one-line truth. Silver didn't crash. Paper silver was forced to reset while physical stayed tight. Disclaimer. This video is for educational and informational purposes only. It is not financial, investment, or trading advice, and should not be interpreted as a recommendation to buy or sell silver or any other asset. Always do your own research or consult with a licensed professional before making financial decisions.